everyone, hope you're doing well. This is the Deep Dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And I'm joined, as always, by John Creekmer, our founder and Senior Wealth Advisor. And John, we're going to talk some current events. Markets are getting a little interesting right now. So we just want to walk through what exactly is driving things and what are the key factors that we're keeping our eyes on. But John, before we hop into all of that, how you doing? What's been going on?
I said doing well, and it's just like this. First, we always knew the first 100 days of this presidency, things are kind of crazy, and so good, bad, right or wrong. We're big believers in truth and time. We're agnostic as far as on positions. We simply look to say, hey, what is going on, and how do the different policies redefine the winners and losers, and what does it mean as far as stability in the short term? So you can have a position that you believe that the decisions become more from austerity measures is the best position to get our balanced budget in more in line instead of being $2 trillion in the hole from year to year, and get the debt more under control. But doing so, that does cut back and decrease the GDP probably by about a third in the United States as far as on the growth side. And so that will have effect as far as on companies' earnings in the stock market. So, keep in mind that sometimes short-term decisions do have long-term impacts. And so both on the positive and negative side. So we're just kind of walking through that right now, and it's been very interesting to say the least. And we don't judge what's right and what's wrong. We simply interpret how it affects clients, and I want to go over that a lot today because it's really at the heart of what we see happening in the marketplace right now.
Absolutely. John, before we dive into more of the specific things that are going on, maybe from a policy perspective, let's just talk big picture about where we're at in the market cycle, and talk a little bit about valuations, because that's another key factor that we watch. But if you've listened to the deep dive over the last number of months, you've heard us talk about how bull markets last on average 18 to 24 months. And the current bull market run that we are in and maybe exiting here shortly, it's a little bit long in the tooth. It's about 27 months in length at this point in time. And so we are definitely in the latter stages of this bull market run. And we're starting to see things from an economic standpoint that you tend to see occur in the latter parts of a bull market run. Primarily slowing revenue growth, which, John, you've talked about that for years as being a key factor. Anytime you see companies' earnings begin to slow down, that's typically a sign that the market is due for a pullback. And so, as we've talked about many times, we've been slowly raising gains over the last number of months, primarily because of where we were at in the market cycle. Now, John, that said, in recent days, you alluded to this, there's been some changes on the policy front, which has seemingly caused the markets to begin to pull back. I believe the S&P is down about 5% here in the last couple of weeks, and we're getting a pretty volatile day here on March the 3rd, or Monday. And so, John, why don't you just walk through how, in the short term, some of those policy changes are affecting the bigger picture?
So sometimes, like, things totally change right before your eyes. And you're thinking things go one way in the direction as they go the other. And we see the same thing in the economy. And so, quite honestly, in the economy, we really look for patterns. And so, over the last 18 to 24 months, we have been in this bull market. We went from the market low up to the market high. And typical, that's the usual length of time we see for a bull market whenever we see there's intermediate term highs. And then we hop down to an intermediate term low, takes 4 to 7 months. But right now, Drew, we've actually extended that by 3 months. And that's not necessarily a bad thing. But what it does, it means the market's gotten stretched. And so what does it get stretched from and stretched to? So it gets stretched from valuation, and it gets stretched to euphoria. Now, whenever we get to that spot, we always have to look to see there's events that happen that drive the next movement in the marketplace. And so, Drew, we've been talking about, as far as long in the tooth, the markets are kind of been on this upward trajectory as far as the bull market. But then all of a sudden, we see things that happen. Whenever earnings slow, which right now we see a slowdown in earnings momentum across the board, especially the technology sector, the sector that really drove last year, which really the theme was artificial intelligence. We see a slowdown across the board as far as the earnings from other growth names. And then we look at other things from the overall economy. And so we had an inflation number, inflation numbers kind of got a little bit unusual, and so we're seeing inflation still being ornery. It's kind of moved down from where it was 12 months ago, but it's still being a little bit sticky. And then on top of the unemployment numbers, actually we're a little bit higher than what we anticipated last month. And then this next Friday, we have new employment numbers coming out. And Drew, if we only see maybe less than 100,000 new jobs created as far as the previous week, well, then that's going to be a sign the economy is really slowing down in employment. That might force the hand as far as from policymakers, but also as far as from Federal Reserve. So Right now, we are seeing employment numbers being affected. We're seeing inflation numbers. We're seeing consumer confidence. We've had 3 straight months in a row of consumer confidence going backwards. And so all of those things typically are leading indicators that we are going to see the economy slow down. Now, the stock market typically does lead the economy. And so if we see the market pull back, I think that we could see that as being a positive, and getting back to where we need to be. Drew, I know that you mentioned we're down about 5% on the S&P 500 for the most recent intermediate term high. Realistically, we could be down somewhere between 10 and 12% here in the next week or two. And that'd be a very normal thing to see happening.
Yeah, yeah, and a pullback of 10 to 15%, John, and historically that happens once, if not twice a year historically, and then that's not the end of the world, right? That's a healthy pullback. And to your point, whenever valuations have been stretched like they are now, a pullback can be healthy because the market's resetting and getting away from that euphoria, which leads to potentially a bigger issue down the road. And so, John, I think the big picture that we always bring back to is right now we're seeing a lot of signs that are out there that things are slowing down, and the market is starting to show that by pulling back a little bit. And that's why we've been proactively taking gains out of the market and getting a little bit more conservative and also shifting to some of those consumer staples. So think a company like Johnson & Johnson or Procter & Gamble, companies that make products that no matter what's happening in the economy, consumers have to purchase. And historically, those stocks hold up much better than, say, a high-flying tech company like maybe an NVIDIA. And so, John, when you think about just how folks should be thinking about their investments right now in this moment in time, what would you bring everything back to for them?
At the end of the day, we need to really kind of detach ourselves a little bit from the underlying investments and instead be looking at what are the goal objectives that you have as an individual. And truly, if your goal objective of when you need to access your cash or your investments is less than 24 months, if that is the case, then you need to be actually taking less risk and having money off the table, especially when we're in a period of time of instability. If your time horizon really is a longer period of time, then what you're going to be saying is that's longer than 24 months. Then what you're saying is I'm able to withstand some of these intermediate term pullbacks in order to give me an opportunity for a higher rate of return. Now, that does not mean that we're not proactively finding ways to take money out of the marketplace to preserve gains and set aside in cash to be able to, from a strategic standpoint, be able to buy in at a lower and lower price. And so whenever you kind of think about that, you want to say, let's align goals with our investments and our portfolios. Now, whenever you do that, though, it needs to be intentional and not reactionary. And so over the last 35 years, Joe, I've seen so many folks respond from a reactionary standpoint, and you end up making emotional decisions at the absolute wrong time. And so at the end of the day, folks, make sure you understand your goals, understand your time horizons, and when you are going to be needing to access those monies.
Yeah. Yeah. Actually, always bring it back to the goals and the primary objective of what each dollar is supposed to do for you in the short term and the long term is key when making those investment decisions. And John, we feel like our clients are actually positioned in a fantastic place for this specific moment in time, but also just from the conversations we've been hearing from our advisors that are having with clients around the country. It's great to hear that folks are really focusing on the goals and making wise, informed decisions based upon that rather than an emotional reaction. And so, what we'd encourage you guys to do, if you have any questions about your overall financial plan or about your investment portfolio and how it's aligned for those goals, we'd encourage you to reach out to your advisor, set up a strategy session with them. Our team is standing by and ready to help in whatever way that we can. So, thanks for the time, y'all, and we'll talk to you all soon.